Hello my dear friends, in our channel Money Minded RV, we will be discussing in matters related to finance. In this we will be deeply analyzing the financial matters, the financial equation and all and everything that needs you to have and develop money. So in this we will be discussing a lot more about investments, investors methods and lot of things. In this channel we will be discussing about mutual funds, we will be discussing about insurance, we will be discussing about gold, we will be discussing about real estate and many more such investment objectives. We will also be discussing about various methods that are there for investing. We will be discussing about SIP, we will be discussing about lump sum, we will be discussing about STP, we will be discussing about SWP and many more such ways of investing. If this video series or any video has brought any change in your financial journey or do you like my videos, then please put up that like button and do share it with your loved and close dear ones. I also request you to subscribe to my YouTube channel and press that notification button so that every video reaches you first. So let's start today's point of discussion. Thank you. Hello friends, today's topic of discussion is the most talked about and the most brewing topic in financial education classes, that is SIP. S stands for systematic, I stands for investment and P stands for plan. Systematic investment plan, in short, what every one of us know as SIP. So let us understand what is an SIP. Systematic investment plan is a method of investing in mutual funds where an investor invests a fixed amount of money at regular intervals, typically monthly or quarterly. This fixed amount of money can be varied like based on step up and step down of step up. SIP means this year you deposit an amount of 500 rupees as SIP. Next year what you do, you make it 550 or 600 rupees. That is called step up. You increase the amount. Suppose this year you invest a money of around 1000 rupees and next year you find 1000 rupees difficult, you decrease it to 900. That is called step down. You can change that amount, but usually it remains a fixed amount for a certain period of time. That fixed amount automatically gets debited from your account, goes into the AMC and gives you the returns. This is usually suited for investors who look to achieve various financial goals such as wealth creation, retirement planning, or funding the education of your kids. The main benefit of an SIP is it provides flexibility to adapt to the changing financial circumstances. No matter what happens, the SIP gets adjusted as soon as there is any financial changes that occurs in the market. So let's understand the working of an SIP. Let us consider a case scenario where Miss Sarah, a dynamic individual aged 24, is working in an MNC with good salary. One day she meets her banker, Mr. Dheeraj, and discusses about the investment options to make her future secure. Mr. Dheeraj, a senior manager at a renowned public sector bank with good knowledge in investment related activities. Let's understand what explanation Mr. Dheeraj gives to Miss Sarah after he had a detailed discussion and after he understands the basic needs, necessities of Miss Sarah and the concerns she has about her future. So Mr. Dheeraj says, SIP is usually a deal between an individual and an AMC whereby the individual pays money to the AMC and in return the AMC issues units on pro rata basis. Pro rata means that is called NAV. Pro rata means based on the NAV. If you provide 1000 rupees, if the NAV is 10 rupees, then you will get 1000 divided by 10, that is 100 units. What is NAV and how this NAV is calculated, etc. I already have a video in this channel, and if you have any doubts on NAV, you can just refer to that video. It is just around 5 to 10 minutes video. You can understand NAV in details. I have discussed every details about NAV in detailed manner, including the calculations, so you can just go there and check it. Pro rata basis means that what is the NAV of that day, the amount you are investing, the total amount invested divided by the NAV amount will be the number of units that the AMC will be handing over to you. and these units are then accumulated every month as you deposit, depending on the NAV. The AMC gives you the units and you go on accumulating it and withdraw it when the need arises. So, as an analogy, Miss Sarah, when she has money, she gives it to a fund manager. Suppose Mr. Dheeraj is a fund manager, and this fund manager of the AMC has units. These units are then transferred to Miss Sarah, who accumulates it, and when she needs, she can sell each based on the number of she can sell, as Miss Sarah goes on accumulating. Miss Sarah has an option. She can sell units as and when required. She can sell one unit, she can sell fraction of it, she can sell more units as per her need. She can do it. So what actually happens when the money is invested? Let's see. So firstly, we have the money. We give it to an AMC. AMC, there are a lot of AMCs in India. So these AMCs have our fund. As soon as they receive our money, they divide it by the NAV of the fund, and that generates the units. These units are given to us while the money is invested in the asset. This money is invested into the assets. These assets then grow and generate benefits. Means, suppose they had invested in shares of Reliance which were trading at 800 rupees, and after 5 years the shares went up to 1000 rupees. That is the growth in the asset that we say. Asset means there are a lot of assets. You can consider stocks, you can consider real estate, you can consider gold. There are companies, there are funds which invest in everything. There are AMCs, and there are funds which invest in abroad, what it is called equities, like Google, Meta, like all these shots. So the main objective is, as soon as the AMC receives the fund, it issues us units, and these money gets invested in assets. These assets grow. And the AMC generates profit. And this profit is shared to us as returns. That is the ultimate return that we obtain. So let us see an example of an SIP functioning. So like here we have considered a hypothetical situation of a 1 year SIP where 1000 rupees is the SIP amount. We have an NAV, and the variation of NAV is quite erratic. We have made such quite erratic quite erratic NAV movement. Usually NAV movements are not that erratic, but we have taken it for a good example. So now we have invested 1000 rupees. In 1 year we have invested 12,000 rupees. So the present value of 12,000 rupees is 12,704.94. The NAV has been varying every month. So the average NAV comes down to 266.5. You can calculate. See, there were periods where the NAV was 280, there were periods where NAV was 240, there were periods where NAV was 256. So on an average, your average NAV comes to 266.55. Thus the total cost of acquiring, the average cost of acquiring total units of 45.16 is 266.15. If you had invested in the month of November or December, or in the month of January or February, only if you have invested one time only in those situations, then the NAV would have been 284. That would have been a very huge NAV. But as you have invested 12,000 in 12 months, the average NAV, the average cost is lower. This is the main benefit of SIP. The average cost of investment goes down. Now, benefits of SIP. The first benefit is lighter on wallet. Lighter on wallet means can be started with a very small amount. It can be started with amounts like 500. Some funds even were offering 100 rupees as SIP benefit. So what happens is it doesn't weigh much on your wallet. You can you can freely invest in those SIPs. The second benefit is makes market timing irrelevant. As you have seen in our previous example, the SIPs NAV, the fund's NAV was keeping on changing. It was 282, 281, 284, etc. It was keeping on changing, but our investment, as it was constant, we got an average NAV of 266.55. Thus, what happened previously, what happened in market, what happened in market went up, what happened when market went down is immaterial to us. That thus market timing is irrelevant. My teacher once said to me that time in market is more important than timing the market. So with SIP, you don't have to time the market. You just get the benefit from it. The next advantage comes down to enables rupee cost averaging. Enables rupee cost averaging is, I hope you understand, different months, different NAV, but the average NAV is usually lower than the highest amount of NAV. So usually your cost of acquiring the investment goes down. Now the next is benefits from the power of compounding. Benefits from power of compounding means as the years goes on, as the years pass on, the NAV of the fund increases. As you are going on an SIP mode, the average cost of acquiring is always lower, because initially your NAV will be low, towards the end your NAV will be high, but when your average comes out, it will be very low. So the cost of acquiring is very low. Thus the power of compounding works to our benefit. The next benefit is helps in goal planning. Actually, if you have a plan like retirement plan, you have a goal like it is around 20 to 30 years from now. So you can plan how much money you need, and based on that you can start an SIP. You can calculate the return and you can plan your retirement. Any financial goal that needs your look can be planned effectively using an SIP. And in this channel we will be discussing about all goal plannings, and so stay tuned to our channel for any further updates like that. Then we will be discussing then the last benefit is tax efficiency. Tax efficiency, the main benefit of tax efficiency is the total amount of SIP gains is not taxed. Unless and until you withdraw, the tax doesn't happen. So this tax efficiency part we will be discussing more details in the next slide. I hope the benefits of SIP is clear to everyone. So we will be discussing about the taxation part in SIP. Actually, the taxation is usually levied on the amount that is withdrawn based on the capital gains tax. The total gain or presumed gain, as in case of fixed deposit, is not taxed. This means if you are investing in an SIP, correspondingly if you are investing in an RD, recurring deposit, that of a bank. So suppose you are depositing in an RD for 5 years. Every year what happens? Your expected income will be taxed. Accrued interest will be taxed. But in SIP that doesn't happen. SIP, no matter how much you gain, but unless and until you withdraw amount from your mutual funds, it is not taxed. So the benefit is you don't have to pay tax on your investment until you withdraw. And at the time of withdrawal too, if you plan properly how to withdraw, the withdrawal process, etc., which has been discussed in my channel and the videos called SWP, you can really make your taxes go really down. So let us see what are the taxes prevalent in India at this juncture of time. There are two types of funds, equity and non-equity funds. You can consider that non-equity funds as debt funds. So STCG and LTCG. STCG is short term capital gain, LTCG means long term capital gain. Short term capital gain in equity means 15% tax will be there. Short term means if your period of holding is less than 1 year in equity. Long term means if your period of holding in equity is more than 1 year, means you invest and you withdraw before 1 year, it is called short. You come under short term capital gains. You invest and you withdraw after 1 year, you come under long term capital gains. Non equity funds, if you invest and withdraw within 3 years, then it is called short term. After 3 years, it is called long term. So if you go for an STCG in equity mutual funds, it is flat 15%. Whatever gains you have, 15% tax will be deducted. But if you go for an LTCG, long term capital gains in equity funds, whatever gain is there, from there 1 lakh gain is subtracted and the remaining will be taxed. Suppose 5 years back you had invested 1 lakh rupees. That in these 5 years grew up to 3 lakh rupees. So your capital gain is 2 lakhs. In these 2 lakhs, you can your gain of 1 lakh is subtracted, because for 1 lakh you don't have to pay any taxes. So the remaining 1 lakh will be taxed at 10%. So your taxable amount will be 10,000 only. But if it was a fixed deposit or something, your total 2 lakhs will be taxed and your total tax will be 20,000 rupees. So it's really tax efficient. For a debt fund, if you go for an STCG, the tax rates will be as per your individual tax bracket, and long term capital gains will be 20% with indexation. Indexation means 1 lakh 5 years back will be almost equal to 1.5 lakhs 5 years later. So the cost of your investment will be calculated likewise. Suppose, for example, if you had invested 1 lakh in the 5th year and you in a debt fund and you got 3 lakhs at the end of the 5th year, so you have a capital gains of 2 lakhs, right? It doesn't work like that in long term capital gains in debt funds. They will your total withdrawal amount is 3 lakhs. You had invested 1 lakh 5 years back. The cost of the investment 5 years from 5 years after that is like 1 lakh. They will calculate based on the CPI indexation. That 1 lakh might be worth 1 lakh 75,000 after the 5th year. So 3 lakhs is the total withdrawn amount. 1 lakh 75,000 was the total cost of investment. So 3 lakhs minus 1 lakh 75,000 will come to 1 lakh 25,000. This 1 lakh 25,000 will be taxed at 20%. So your car will come at around 25,000 something. So that is the benefit of indexation. So that is the benefit of tax saving in mutual funds. So as we come to the end of this video, I really would like to thank you for having a patient listening. This was a very short video, and please press the like button if you like my video. Please share this video with people who need to have this financial knowledge. Please do subscribe to my YouTube channel. Press the bell icon so that you can stay updated with all the latest updates from my channel. Thank you guys.